A staggering 66.2% gross margin makes TSMC look completely untouchable in the global chip race. Yet Intel is burning billions, and the market still has not priced in a hidden trap that could wipe out your portfolio's semiconductor gains. TSMC effortlessly funds the architecture of tomorrow, whereas Intel desperately relies on heavy subsidies just to survive today. But is Intel truly dead money? Or is there a hidden fundamental pivot occurring beneath the surface that we are entirely missing? When you look at the explosive 35.1% revenue surge from TSMC, it absolutely demands your immediate attention. But Intel posting a 7.2% revenue increase actually beat internal expectations. At first glance, you might think both giants are scaling artificial intelligence infrastructure at record speed. But when you look at profitability, the winner looks much more vulnerable. TSMC expanded its gross margin, which is simply the percentage of revenue left after paying for direct production costs, by 740 basis points to an astonishing 66.2%. Intel reported a much weaker GAAP gross margin of 39.4%. The competitive twist is even more violent in operating profitability. TSMC delivered a breathtaking 58.1% operating margin. Intel collapsed to a negative 23.1% operating margin. Why does this matter? TSMC possesses a near monopoly on pricing power, turning its bleeding-edge silicon into a self-sustaining cash engine. Intel is struggling with the punishing initial costs of a massive manufacturing reset. For your stock market analysis, that 35.1% top-line revenue growth means absolutely nothing if the underlying operating leverage is rapidly deteriorating. This is the cornerstone of sound value investing, because buying growth without margins is a recipe for disaster. But to fully grasp why this profitability gap is widening, we must look at something seemingly unrelated: the sheer capital required to survive the architectural physics barrier of sub-2 nanometer chips. TSMC spent a massive 350.7 billion new Taiwan dollars in capital expenditures, while Intel spent 4.96 billion US dollars on gross capital expenditures. Yet the true story lies in the conversion of that spending. TSMC converts its investments so efficiently that it maintained a highly positive 30.7% free cash flow margin. Free cash flow margin represents the cash a company actually keeps after paying for its operating expenses and capital expenditures. Meanwhile, Intel plunged into a deeply negative 14.9% free cash flow margin. TSMC builds factories and gets richer, immediately translating capital into explosive growth as its advanced platforms surged 53.5% year over year. Intel builds factories and bleeds cash, struggling to keep pace as its own foundry division grew a much smaller 16%. This is exactly why your fundamental analysis requires looking past surface growth to the quality of the cash conversion cycle. What does this specific divergence mean for your long-term positions? It means TSMC organically funds its future, while Intel finances a high-stakes gamble on its sub-2 nanometer nodes. This brings us to how these companies keep the lights on. Intel boasts a staggering $32.8 billion US dollars in combined cash and short-term investments, while TSMC holds an equally formidable 3.03 trillion new Taiwan dollars in cash equivalents. Both appear to possess fortress balance sheets, but when you examine their leverage, the illusion shatters. TSMC operates with a pristine 17.8% debt-to-equity ratio. Intel sits at a notably higher 0.36 times debt-to-equity ratio. Furthermore, Intel is increasingly reliant on complex alternative financing, securing $2.06 billion US dollars in external partner contributions just to shoulder its foundry expansion. TSMC requires absolutely zero external partner bailouts. TSMC's massive cash pile is pure, unadulterated excess capital generated by operational supremacy. Intel's $32.8 billion US dollar liquidity is a necessary life raft, meticulously designed to absorb years of structural cash burn. For your investing strategy, the lesson is clear. Liquidity derived from debt and partner equity is fundamentally riskier than liquidity generated by selling a vastly superior product. And this is something you can easily check for yourself before buying any stock. But before you declare the American Titan completely defeated, we must examine a terrifying vulnerability hidden deep within TSMC's $8.66 trillion new Taiwan dollar balance sheet. TSMC reveals that a staggering 84% of its accounts receivable, which is the money owed to it by buyers, are tied to just 10 major customers. Conversely, Intel leverages a vast enterprise network, generating $13.6 billion in total revenue across a highly diversified global supply chain to mitigate its risk. This extreme concentration is TSMC's single greatest vulnerability. If Intel can leverage its footprint to peel away even one or two of those mega-cap tech clients for its own advanced node production, the entire market dynamic violently shifts. Intel is aggressively pitching its Western supply chain as the ultimate insurance policy against global uncertainty and market volatility. For your stock market analysis, you must realize that a monopoly is only as secure as the loyalty of its top buyers. Diversification is the ultimate weapon against supply disruptions, making Intel's customer base its hidden fortress. Yet, to win those top 10 customers, you need flawless execution. And that brings us to the most shocking discrepancy in the quality of their earnings. TSMC posted an incredibly clean 573 billion new Taiwan dollars in net income, which is the total profit remaining after all expenses and taxes are deducted. Intel, by contrast, reported a staggering GAAP net loss of $3.73 billion. Management at Intel quickly points to their adjusted figures, highlighting a $1.48 billion adjusted profit to calm the markets. Looking under the hood reveals a brutal truth. While TSMC accelerated its research and development spending by 19.8% to guarantee it wins the physics battle of next-generation silicon, Intel was forced to absorb a massive $4.07 billion Goodwill impairment charge. That $4.07 billion write-down is primarily tied to its Mobileye unit, showcasing the severe permanent cost of distracted corporate focus. TSMC's earnings seamlessly convert to actual cash, while Intel's top-line revenue growth masks a severe deterioration of its legacy assets. Whenever management heavily relies on adjusted figures to hide multi-billion impairments, your margin of safety is actively eroding, which is exactly why fundamental analysis is critical. The ultimate price of this margin erosion is felt directly in shareholder returns. Because the race to sub-2 nanometer architecture is so incredibly expensive, TSMC confidently hiked its dividend payout to 7 new Taiwan dollars per share. Intel completely suspended its cash dividend, recording exactly $0 in dividend outflows this quarter. While TSMC is allocating 155.6 billion new Taiwan dollars to shareholders, Intel returns absolutely nothing to its investors, forcing them to endure a capital desert simply to fund sheer survival in the fabrication arena. For those focused on value investing, this divergence is your ultimate warning sign. A suspended dividend in a highly capital-intensive industry often signals that the underlying business model is frantically fighting for its life. But to truly understand who will dominate the next decade of silicon, we have to look at the unprecedented level of state intervention shaping these massive balance sheets. TSMC accepted a relatively modest 505 million new Taiwan dollars in global grants this quarter. Intel recognized a highly volatile $1.09 billion mark to market loss on escrowed shares tied to massive public funding agreements. Both companies are navigating a complex environment where global supply chain reconfiguration is paramount, but TSMC is using targeted grants simply to mitigate its own regional concentration risk tied to those 10 major customers. Intel is deeply entangled with government initiatives, making its financial statements highly sensitive to sudden policy shifts and global risk premiums. Businesses relying on organic pricing power always outlast those heavily dependent on public subsidies. This brings us back to our opening question regarding that 66.2% margin. Is Intel truly dead money, or is there a hidden trap about to wipe out your portfolio's semiconductor gains? The ultimate verdict is that TSMC is not just winning the sub-2 nanometer architectural race, it is entirely self-funding it. TSMC's unmatched operating leverage means it can effortlessly outspend competitors while richly rewarding its shareholders. Intel remains fundamentally burdened by poor capital efficiency and the ghosts of its past acquisitions. While Intel's massive liquidity offers a theoretical safety net, the sheer cost of catching up makes it a structurally riskier choice for your investing strategy. Therefore, here is my final prediction for the next 24 months. We will see a massive repricing event. The market will stop valuing semiconductor companies on their top-line revenue growth and start ruthlessly penalizing those with negative free cash flow. Intel's inability to organically fund its next-generation nodes will cause its stock to chronically underperform over the next 2 years. Meanwhile, TSMC's pricing power will solidify its absolute dominance in value investing portfolios worldwide. But I want to hear your take. Do you believe Intel's massive foundry gamble will eventually pay off? Or is TSMC's sub-2 nanometer lead truly insurmountable? Please let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.